Hi, my name is Roger Schluter. This video is actually about how a recession impacts bank lending, and we'll really go over that pretty specifically. And that's if kind of you're in the U.S. And I don't know if it's the same everywhere. Probably most banks act the same, regardless if they're in Europe or South America or actually the U.S. So anyway, we're going to talk about that, and then at the very end, I think I'm going to do some projecting on what I think the end of this year and next year will bring. So anyway, any serious talk about an economic recession will have most banks limiting their lending. In most recessions, individuals and businesses usually cut back on their spending. This makes it very difficult for new and expanding businesses to really hit their numbers. And that's what banks want them to do. They want them to hit their numbers. They want them to do what they said they were going to do. This will in turn reduce their sales, which reduces obviously their net income, which severely decreases their bottom line. This environment is also very difficult for startup businesses. Startup businesses, they really have a difficult time, even in good economic times. So normally with a recession, the Federal Reserve will reduce interest rates. And they do this basically to increase lending demand and hopefully lessen the impact upon businesses and consumers. Obviously, this is a good time to borrow long term, at low rates, and or to extend your loans at a lower fixed rate, only if you can get a fixed rate. This is great if you can find a bank to lend to your business at a fixed rate. Most banks curtail their lending during a recession, and if they do lend, they would rather lend at a short-term variable rate that will actually rise when interest rates go up. Banks are also taking care of businesses that are getting hurt in the recession with lower sales and earnings. Many banks actually will tell their hurting businesses to find another bank, or will raise their rates if their loans come up for renewal. You think this is kind of dirty pool, but banks are in business to make money. So anyway, banks usually reduce the lines of credit, or at this time, basically because a line of credit can be accessed even though the business is actually going out of business. And I've seen this before in lending. I mean, if you're a business and you're having difficulty and you have this huge line of credit, and maybe not even that big line of credit that's just sitting there with zero on it, as you're going down the tubes, a lot of businesses will go ahead and access their line of credit and bring it all the way up to the max of their line of credit. They do this because they can. The bank can't really turn it off until the end of that period, and usually they're done for a year. So anyway, that is why when you're lending on lines of credit, you only make them for 1 year. And that is so you can reduce or curtail them at this period. Many businesses will have their line of credit reduced or, sadly even eliminated when they need that line of credit the most, during a recessionary period. Bottom line is banks do not like to lend during a recession. And, that is because many businesses either, may go out of business or they may, have problems with their business. Now, that all being said, this is being written in late summer of 2022. In the U.S., we have inflation of approximately 8 to 9%. The Federal Reserve is raising rates dramatically, or drastically, whichever way you want to put it, to combat inflation, which was probably caused by the extensive stimulus the federal government had given during the health problems that started in the spring of 2020. Many economists think we're already in a recession. And if so, the raising of interest rates could have drastic effects to the economy, for the end of 2022 and into 2023. This can be actually a double whammy for borrowers, because banks don't like to lend in recessions, and banks don't like to lend when rates are rising. And the reason is the bank would rather lend after the rates had risen. They do not want to miss out on the higher rates. So most loans will be on a variable and short-term basis. And that means that most banks will lend on a short-term basis and on a variable rate, which will go up as things go up. And then they'll try to keep them short-term so they can go ahead and renew them or eliminate them as your loan comes up for renewal. So anyway, nobody has a crystal ball. Hopefully inflation will go down quickly so the Federal Reserve could reduce rates and come out of the potential recession quickly also. So anyway, time will tell. I mean, I'll either look back at this and say, hey, I nailed it, or I'm going to look back at this and say, what a fool. You know, it didn't turn out anything like I said. So anyway, take this with a grain of salt. You know, I am not an economist, and I don't pretend to be one, but I have some experience in the lending world. So anyway, if you like this kind of content, please subscribe and hit the bell notification so you're notified when new videos come out. And also, please hit the like button if you learned anything from this video. So anyway, thank you very much. My name is Roger Schlueter, and I will see you in the next video.